Look, imagine this. You're grinding away at your 9 to 5 in some bustling city like Chicago or Atlanta, finally paying off those crushing student loans that have been hanging over your head since college. And you've managed to sock away a decent chunk in your 401k. But then, bam, you hit that $250,000 mark in your investments, and suddenly everything feels different. You're scrolling through your brokerage app, seeing your balance spike on a good market day, and you think, hey, I've made it. Time to upgrade that beat-up sedan or splurge on a family trip to Disney. But here's the kicker. That's exactly when most Americans trip up, turning what should be a launch pad into a financial black hole. Today, we're unpacking why $250,000 isn't the victory lap you think it is. It's a psychological minefield that could derail your shot at the American dream. My name's Troy, and I spend way too much time thinking about why so many hardworking folks hit wealth milestones like $250,000 only to sabotage themselves right when compounding starts to kick in. If you're someone who's finally built up a solid nest egg but feels that nagging urge to level up your lifestyle or investments, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. All right, let's dive in. Now, you might be thinking, Troy, $250,000 sounds like a win. Why call it a trap? Well, here's the thing. Most people chase the American dream thinking it's all about hustling harder, maxing out that Roth IRA, or riding the S&P 500 wave. But what nobody tells you is that wealth building isn't just about the dollars. It's a mind game, especially when you cross that $250,000 threshold. I've seen it time and again. Folks who were disciplined savers suddenly start acting like they've won the lottery, only to watch years of progress evaporate. And trust me, I'm a bit frustrated by it because it's so avoidable if you understand the psychology at play. First off, let's challenge this big myth right out of the gate. Wealth accumulation is linear. Save $10,000, you're $10,000 ahead. Hit $50,000, pat yourself on the back. No, that's beginner stuff. Once you reach $250,000, the rules change because your money starts outpacing your paycheck. Picture this. The Federal Reserve tweaks interest rates, the S&P 500 jumps 2% in a day, and suddenly your portfolio's up $5,000, more than what many Americans take home after taxes in a month. That's exciting, right? But it's also where the danger creeps in. Your brain shifts from survival mode to I've arrived mode, and that's when common sense takes a back seat. Let me back this up with some hard data. According to the Federal Reserve's latest survey of consumer finances, the median retirement savings for American households is around $87,000. Pitiful when you consider the average worker earns over $2.5 million in their lifetime, adjusted for inflation. Yet only about 10% of Americans have $250,000 or more in investable assets. Why the gap? It's not just inflation or those pesky student loans averaging $37,000 per borrower. It's psychological traps that hit hardest at this level, turning potential millionaires into perpetual middle-class strugglers. Here's what most people don't realize. At $250,000, you're entering the illusion of arrival phase. It's like finally affording a down payment on that suburban home you've dreamed of, the American dream staple, but then treating it like you've got endless equity to burn. Psychologically, this is rooted in something called the endowment effect, where we overvalue what we have just because it's ours. You see your balance grow passively, and suddenly spending $10,000 on a home renovation or a new SUV feels justified. I've earned this, you tell yourself. But let's do the math to show why that's a rookie mistake. Suppose you've got $250,000 in a diversified S&P 500 index fund, earning an average 7% annual return after inflation. That's conservative based on historical data from Vanguard. In year one, that's about $17,500 in growth, no effort required. Now, if you pull out $10,000 for that well-deserved splurge, you're not just losing $10,000 today. Over 20 years with compounding, that $10,000 could have grown to over $38,000. Factor in opportunity cost, and you're talking a $50,000 hit to your future self. That's real money, enough to cover a kid's first year of college or boost your Roth IRA contributions. And don't get me started on credit scores. One impulsive financed purchase could ding yours, making future loans for that dream house more expensive. But wait, this is where it gets really interesting. The overconfidence monster rears its head next, and boy, does it love feeding on Americans at this stage. You remember the Dunning-Kruger effect? It's that cognitive bias where people overestimate their skills after a bit of success. You've weathered a market dip, like the 2022 bear market where the S&P 500 dropped 25% and your portfolio bounced back. Now, with $250,000, you think, I'm basically Warren Buffett light. Suddenly, you're ditching safe bets like broad market ETFs for hot stock picks or crypto gambles. I've heard stories from viewers who lost $20,000 chasing meme stocks, thinking, I can afford the risk. Can you? At this level, a 10% portfolio loss is $25,000, more than the average American's annual 401k contribution. Let me give you a concrete example with US dollars to drive this home. Say you're 40, with $250,000 split between a 401k and a Roth IRA. You're contributing $6,000 a year to the Roth, maxing it out like a pro. If you stick to boring index funds tracking the S&P 500, projecting 8% returns, historical average, you'll hit $500,000 in about 9 years, assuming no extra contributions. But if overconfidence hits and you allocate $50,000 to a speculative play, like some hyped EV stock that tanks 40%, you're out $20,000 immediately. Recovering that? It sets you back 2 to 3 years of growth, plus the emotional toll that might make you pull out during the next Fed-induced volatility spike. Analogies help here. Think of it like climbing Mount Everest. Getting to base camp, $250,000, is grueling, but the death zone is ahead, where thin air, high stakes, makes every step risky. One wrong move, like slipping on ice, a bad investment, and you're tumbling back. The American dream sells us this idea of constant upward mobility, but at this point, it's about steady footing, not sprinting. Now, shifting gears to keep things moving, because I know that middle video slump is real, let's talk about the comparison trap, which is sneaky and hits Americans hard in our social media-saturated world. You've got $250,000, feeling good compared to friends buried in $100,000 of student debt or scraping by on credit cards with 700-ish scores. Then you scroll Instagram and see some influencer flaunting their $1 million portfolio, where a coworker mentions their 401k hit $400,000 thanks to tech stock options. Suddenly, you're behind, right? This triggers what psychologists call social comparison theory, and it wreaks havoc. Data from a 2023 NerdWallet study shows 60% of Americans feel financial inadequacy from social media, leading to risky behaviors. At $250,000, you've got enough to act on it, maybe leveraging a home equity line of credit, HELOC, at 7% interest to invest in the market, chasing 10% returns. Sounds smart? Nope. If the S&P dips like in 2008, down 37%, you're underwater, owing more than you gain, and your credit score plummets, making that American dream mortgage tougher. Here's a relatable metaphor. It's like being in a neighborhood barbecue where everyone's bragging about their grills. Yours is solid, a reliable Weber, but you see the neighbor's fancy Traeger smoker and think, I need that. So you finance it, only to realize it doesn't fit your lifestyle, and now you're paying interest while your old one rusts. Same with money. Stick to what works. Don't chase the Joneses. But hold on. This frustration I feel, it's because I've been there. watching family members blow inheritances or 401k rollovers on sure things. The psychology ties into the American dream's dark side. We're conditioned to want more, faster, leading to student loan epidemics totaling $1.7 trillion nationally, where credit card debt averaging $6,000 per household. At $250,000, you have the power to break that cycle, but only if you debunk the myth that more risk equals more reward. Let's balance this with some positive math and psychology. Compound interest is your best friend here. It's the Federal Reserve's gift to patient investors. With $250,000 at 7% net of inflation, you're generating $17,500 yearly passively. Add $19,500 annual 401k contributions, 2024 limit, and you're snowballing. Psychologically, frame it as wealth momentum, like a freight train picking up speed. The first $250,000 might have taken 15 years of grinding, but the next $250,000, often half the time thanks to compounding. Eye-opening stat? Vanguard's research shows that from 1926 to 2023, the S&P 500 averaged 10.3% returns. If you resist traps, $250,000 becomes $1 million in 15 years with modest additions. That's the behavioral side. Delayed gratification pays off, countering the instant gratification culture fueled by buy now, pay later schemes that tank credit scores. Concrete example? Meet Sarah, a fictional but typical viewer, a 35-year-old teacher in Texas with $120,000 in student loans paid down to $50,000 and $250,000 in her 403b, teacher's version of 401k. She sees her balance jump $7,000 in a month and thinks, time for that kitchen remodel. Instead, if she reinvests, that $7,000 compounds to $28,000 in 20 years. But if she spends, she's back to square one, plus interest if financed. This is where it gets really interesting, the hidden freedom at $250,000. It's not retirement money yet, but it's option money. You can quit that soul-sucking job for a startup gig with equity, knowing a 6-month emergency fund, recommended by experts like Dave Ramsey, covers you. Or negotiate a raise, leveraging your financial independence. Psychologically, this reduces stress. Studies from the American Psychological Association link financial security to lower anxiety, better health. But here's the frustration. People mistake options for license to splurge. That American dream house? Great, but don't HELOC it for risky investments. Stay boring. Auto-invest in low-cost S&P funds, max Roth IRAs, $7,000 limit for 2024 if under 50, and monitor your credit score. Aim for 750 plus for best rates. Shifting pace again, let's debunk another myth. You need fancy strategies post $250,000. Wrong. The pros, they stick to basics. Data from Fidelity shows millionaires average 17% in cash, 55% stocks, diversified simply. No day trading. Psychology, it's about loss aversion. Humans feel losses twice as hard as gains, per Kahneman's research. At this level, protect what you've built. More math. If you lose $25,000, 10% of $250,000, you need 11.1% gain to break even. Compound that over years and it's devastating. Analogy, like dieting. You lose 20 pounds steadily, but one binge week sets you back months. Now, you might be thinking, Troy, how do I avoid these traps? Great question. It boils down to 3 rules I live by, and they're unglamorous, but they work. First, audit your mindset monthly. Check your portfolio, but ask, am I comparing or celebrating? Journal wins, like paying off $10,000 in student debt to combat comparison. Second, run the numbers before any big move. Use a calculator. Project if that $15,000 car upgrade delays your $500,000 goal by 18 months. Tools like Vanguard's Retirement Planner are free. Third, build accountability. Join a community, maybe a Reddit thread on r/personal finance, or hire a fee-only advisor, not commission-based, for a one-time checkup costing $500 to $1,000. In conclusion, hitting $250,000 isn't the end game, it's the midpoint where the American dream shifts from grind to glide, if you play it right. Don't let psychology derail you. Embrace boring, let the S&P and compounding do the heavy lifting, and watch your wealth snowball. Your future self, the one retiring comfortably, debt-free, living that dream, will thank you. So, take action today. Review your 401k allocations, boost your Roth if possible, and run a credit check. If this resonated, smash that like button, subscribe to Try Hard Investor for more no BS financial deep dives, and comment below. What's your biggest trap at $250,000? Let's build wealth together. See you in the next one.